$4 billion vanished into thin air, and for a decade, nobody even knew it was gone. While the world watched high-profile robberies and cyber attacks dominate headlines, the largest corporate fraud in European history was hiding in plain sight. Buried under mountains of paperwork and routed through a labyrinth of shell companies spanning 3 continents. How do you steal money so quietly that the entire financial system shrugs and carries on? Between 2005 and 2015, a sophisticated network of traders, bankers, and middlemen orchestrated what prosecutors would later call Cum-Ex trading, a scheme that exploited a loophole in German dividend tax law to claim refunds on taxes that were never paid in the first place. The mechanics were brutally simple. When a stock pays a dividend, different owners could make it look like they'd all paid the same tax, then each file for a refund. The German government paid out billions to ghosts. This wasn't a smash and grab bank robbery or a midnight hack into servers. It was a daylight heist executed in boardrooms, signed off by lawyers, and processed by respected financial institutions across London, Frankfurt, and Copenhagen. By the time regulators figured out what happened, the money had already been laundered through legitimate investments, luxury real estate, and offshore trusts. The story begins in the early 2000s, when European tax authorities were still digitizing their systems and cross-border stock trading was exploding in volume. German tax law at the time allowed both the previous owner and the new owner of a stock to claim a refund on dividend taxes during a brief window around the ex-dividend date. Traders discovered that if they moved shares back and forth rapidly, with perfect timing, they could create multiple claims for a single tax payment. By 2005, a small group of traders at major European banks had refined the technique into an industrial operation. They would borrow shares just before the dividend date, sell them to a partner who would claim tax-exempt status, then buy them back after the date and file their own refund claim. The German tax office, overwhelmed with millions of dividend transactions, processed refunds automatically. Nobody was checking if the tax had actually been paid in the first place. One of the architects of the scheme was a British trader who moved between London investment banks, setting up dedicated teams to exploit the loophole. His operations became so profitable that banks allocated entire trading desks to the strategy. Internal emails later obtained by prosecutors showed traders joking about printing money and celebrating record bonuses. The scheme scaled rapidly. By 2007, dozens of banks, law firms, and consulting companies were involved, either directly executing trades or providing legal opinions that gave the practice a veneer of legitimacy. Shell companies were registered in Luxembourg, Cyprus, and the British Virgin Islands to obscure ownership chains. The refund claims were filed through legitimate German banks who had no idea they were processing fraudulent requests. The financial crisis of 2008 barely slowed the operation. While the world's attention focused on collapsing mortgage markets and failing banks, Cum-Ex traders saw opportunity. Stock volatility meant more dividend payments, more trading windows, and more refund claims. Between 2009 and 2011, the scheme reached its peak with an estimated $1.5 billion refunded per year on phantom tax payments. The first cracks appeared in 2010, when a mid-level tax inspector in Cologne noticed identical refund claims being filed by different entities for the same shares. She flagged the pattern to her supervisors, but her warnings were buried under bureaucratic inertia. It would take 2 more years before the German Finance Ministry launched a formal investigation. In 2012, Germany quietly changed its tax law to close the loophole, but no public announcement was made and no prosecutions were initiated. The traders adapted. Some shifted their operations to Denmark and Belgium, where similar loopholes existed. Others simply cashed out their gains and disappeared into retirement or moved into legitimate finance roles. The real reckoning began in 2015, when a coalition of investigative journalists across 5 European countries began piecing together leaked documents, court records, and whistleblower testimony. Their reporting revealed the full scale of the fraud, at least of $55 billion in refund claims filed across Europe, with $31.8 billion paid out by tax authorities and approximately $4.5 billion stolen from German taxpayers alone. The evidence for the Cum-Ex X fraud comes from multiple overlapping sources that investigators verified over several years. Court documents from ongoing criminal trials in Bonn and Frankfurt contain thousands of pages of email correspondence, trading records, and internal bank memos. These records show explicit discussions of the tax refund strategy and calculations of expected profits. Banking records seized during raids on offices in London, Frankfurt, and Zurich show the physical movement of money through the system. Investigators traced funds from German tax accounts to trading firms, then through layers of shell companies, before they ultimately reached individual beneficiaries in the form of consulting fees or dividend payments. Legal opinions commissioned by the trading firms provide a particularly revealing paper trail. Several law firms provided written assessments that the Cum-Ex strategy was technically legal under a narrow reading of German tax code, even though the effect was to extract refunds for taxes never paid. Prosecutors later argued these opinions were deliberately misleading, written to provide cover rather than genuine legal analysis. Whistleblower testimony from former traders and bank employees corroborates the documentary evidence. Multiple insiders described a culture where everyone involved understood the scheme was ethically questionable, but convinced themselves it was technically permitted because German law hadn't explicitly forbidden it. One former compliance officer told investigators he raised concerns internally but was told to focus on other priorities. Tax authority data provides the clearest quantitative evidence of the fraud's scale. By analyzing refund patterns, auditors found thousands of cases where identical tax payments generated multiple refund claims from different parties. Statistical analysis showed these patterns could not occur through normal market activity or accounting errors. International cooperation between tax authorities confirmed the scheme crossed borders systematically. The same individuals and shell companies appeared in refund chains across multiple countries, using similar trading patterns and timing strategies. Defense lawyers for the accused traders have consistently argued that the Cum-Ex trades exploited an ambiguity in tax law rather than breaking it. According to this view, if German legislators wanted to prevent the practice, they should have written clearer laws. The defense points out that the trades were executed on public exchanges, processed by major banks, and approved by compliance departments, suggesting they were understood as legal at the time. Some legal scholars have agreed that the German tax code before 2012 was poorly drafted and created genuine uncertainty about whether Cum-Ex trading violated the law. They argue that prosecuting traders for exploiting this ambiguity sets a troubling precedent for criminalizing aggressive tax planning. A significant gap in the evidence involves high-level decision-making at the banks that facilitated the trades. While junior traders and middle managers have been prosecuted, very few senior executives have faced charges. Prosecutors acknowledge difficulty proving that board members knew the specific mechanics of Cum-Ex trading or understood its fraudulent nature. Even though the trading desks generated enormous profits that would have appeared in executive reports. Another unresolved question concerns the role of tax advisors and auditors. Dozens of accounting firms provided services to the shell companies used in Cum-Ex schemes, yet almost none have faced professional sanctions or criminal charges. It remains unclear whether these firms genuinely failed to understand what their clients were doing or chose not to ask difficult questions. The total amount actually stolen remains disputed. German authorities estimate $5 billion was fraudulently refunded through Cum-Ex schemes on German dividends alone. But some researchers believe the figure could be as high as to $10 billion when borderline cases and undetected schemes are included. Recovering accurate numbers is complicated because many trading records have been destroyed and shell companies have been dissolved. The $5 billion stolen from German taxpayers would have funded approximately 45,000 teacher salaries for a year, or built 300 new schools, or covered the annual healthcare costs for roughly 150,000 families. These weren't abstract numbers in government accounts. They represented public services that couldn't be funded, infrastructure that couldn't be built, and social programs that faced cuts during a period when European governments were implementing austerity measures. Individual tax inspectors who tried to flag the fraud faced professional consequences. The whistleblower who first identified suspicious patterns in Cologne reported being sidelined by supervisors who didn't want to pursue an investigation that might implicate major banks. She described years of frustration watching refunds she knew were fraudulent get approved while her warnings were ignored. For ordinary taxpayers in Germany and across Europe, the fraud contributed to a broader erosion of trust in financial institutions and tax enforcement. Opinion polling after the Cum-Ex files were published showed significant majorities believed wealthy individuals and corporations don't pay their fair share, and that tax authorities protect the powerful rather than the public interest. Tax systems depend on voluntary compliance and institutional trust. When taxpayers believe the system is fair and that authorities will catch cheaters, most people pay honestly. The Cum-Ex fraud exploited a vulnerability in that social contract. The assumption that major banks and respected professionals wouldn't orchestrate systematic theft, simply because they technically could. Think of tax law like the rules of a board game. The Cum-Ex traders found a spot where the rule book was vague, then claimed that ambiguity gave them permission to reach directly into the bank. Their defense essentially argues that if the rules don't explicitly say, "Don't steal from the bank," then taking the money isn't cheating. But functional tax systems, like functional societies, can't write explicit rules for every conceivable form of bad faith behavior. They require participants to operate with basic honesty. The scheme also reveals how European financial integration created enforcement gaps. Money moved across borders far faster than regulators could coordinate, and different countries had different legal standards for what constituted tax fraud. Criminal enterprises have always exploited jurisdictional boundaries, but Cum-Ex showed how sophisticated financial professionals could do the same thing while wearing suits and working in glass towers. From a legal perspective, the Cum-Ex prosecutions are testing fundamental questions about criminal intent in complex financial crimes. Can you commit fraud if you genuinely believed your interpretation of an ambiguous law was correct? If your lawyers told you it was legal, does that provide a defense? German courts have generally ruled that the traders knew they were claiming refunds for taxes that were never paid, and that this knowledge constitutes criminal fraud regardless of legal technicalities. But these remain contested questions in ongoing appeals. What we know for certain, billions of euros in tax refunds were claimed and paid on dividends that generated phantom tax credits through rapid stock trading. Multiple criminal convictions have been secured, and prosecutors have confirmed this was systematic fraud, not legitimate tax planning. What remains uncertain? The full scale of the theft, who at the highest levels knew about it, and how much money has actually been recovered. The Cum-Ex files, journalists and German prosecutors turned scattered suspicions into a documented criminal conspiracy. But most of the architects of the scheme remain unprosecuted. Many banks have settled for fines that amount to a fraction of profits, and billions of stolen euros have never been recovered. Now the question is whether justice systems can actually hold sophisticated financial criminals accountable, or whether complexity itself has become a form of immunity. Short-term additional criminal trials will continue through 2025 and 2026 in German courts, with prosecutors pursuing cases against both traders and banking executives. Several major financial institutions face ongoing civil lawsuits from the German government seeking to recover fraudulently obtained refunds. At least $1 billion in settlements and court-ordered repayments have been secured so far, though collection remains challenging when defendants have moved assets offshore. Medium terms. European tax authorities are implementing real-time reporting systems and automated cross-checks designed to catch similar schemes immediately rather than years later. Whether these systems can keep pace with financial innovation remains to be seen. Several advocacy groups are pushing for stricter liability for professional advisors who facilitate tax fraud, which could create new legal risks for law and accounting firms. Long-term, the Cum-Ex scandal could reshape European attitudes toward financial crime enforcement, potentially leading to more aggressive prosecution of white-collar crime and longer sentences. Alternatively, If most defendants successfully appeal their convictions, or if recovered funds remain minimal, the scandal could reinforce cynical views that wealthy financial criminals operate with impunity. The $34 billion heist worked because it hid in complexity, moved through legitimate institutions, and counted on the fact that nobody watches the paperwork. It failed because a few investigators refused to accept that legal ambiguity justified systematic theft from public treasuries. The cases still unfolding in German courts aren't just about recovering money. They're testing whether financial systems can police themselves or whether enforcement will always arrive a decade too late. If you want to understand how financial oversight fails and what it takes to catch sophisticated fraud, watch next. How 3 journalists exposed the world's largest tax fraud, to see exactly how the Cum-Ex files investigation unraveled the scheme. Thanks for watching. Don't forget to hit that subscribe button and join our community for more amazing videos!